Hi, and welcome back to our Mailbag series. I'm Dave Lopez.
And I'm Chase Lopez, and we're financial advisors with ILG Financial. And this is another episode of Retire Your Way with ILG Financial, where we talk all things retirement planning. My brother told me there's a law from a few years ago that now forces my kids to take a lot of money out of my IRA in the first 10 years after I die. Do I have options to combat this for them? So I'll kind of start this one off. This is actually a recent law. It was passed a few years ago that does in fact say that if with your traditional retirement account, so your traditional 401k or your traditional IRA, if your children were to inherit them, they do have to get the money out in 10 years, right? They have to take the money out, they have to pay the taxes, and then they can do with it, what they want at that point. So,
and in the 10 years, they've got to take the new rule. They've even had to clarify that. The current version of it is not only in the 10 years do you have to take it out, but a certain amount each year at a minimum.
Right.
It's called a minimum required distribution.
Right.
Required minimum distribution. But by the end of the 10th year, it's got to all be out.
Right. So that creates some challenges for the heirs because that gets added to their tax return, whatever that withdrawal ends up being. So there are things that you can do proactively in advance. One tool or one strategy is they call them Roth conversions. Now, this isn't, I'm not saying you should go tomorrow and transfer all of your IRAs into a Roth conversion, but it's definitely something you want to talk to your financial professional about and see if it's a good fit for you. And we have a video actually about Roth conversions as well. So if you want to check out our video on that, that kind of gives you a little bit more detail as to what those are. But to answer your question, there are things that you can do proactively to help with that extra tax burden your children, may have, down the line.
If you care about passing as much on after taxes to the kids, right? And not everyone does, right? Some of our clients will say, look, anything they inherit is gravy, even if they have to pay taxes, as long as I don't have to pay the tax on it.
Right.
And that's a reasonable position. But to Chase's point, we would make recommendations completely different to someone who thinks that way, as opposed to someone says, no, I see my money as two generational money. And my goal is now to minimize the tax hit over my life and my heirs, my son's life or my daughter's life.
Right.
Completely different strategies. Based on your question, if it's that second strategy, really the questions you should be asking your financial professional and your tax professional is, what's our best guess for when this money does come out down the road when I'm passed? My son or daughter has 10 years to take it out. What tax bracket do we think they'll be in? And how does that compare to the bracket I'm in now?
Right.
Again, get with your financial person. They can do the math. We do it all the time and help determine if a Roth conversion or some other strategy might be a better fit.
Yep. All right, Dave, let's hop into the next one.
Okay.
This one says, I have almost $2 million in retirement savings, but I also have a lot of debt. I own a rental property that I could sell, and it would give me enough to pay off all 3 of my cars and all my credit cards, the Parent Plus student loans that I'm paying for my kids, and a personal loan from the credit union. So I think his big picture is if he sells the rental property, he'd pay off all his debt if he sold it. I've always disliked the idea of doing that because I've wanted to have that property for rental income in retirement. Plus, I'd have to pay some capital gains tax when I sell it. Is it worth selling to knock out the debt?
Great question. So I would suggest you look at the question differently. And you hinted at it in your question. First question is, as an investment, do you want to keep the rental property? Right? Is it a profitable investment? Is the rate of return based on the rent you're getting a good investment? And you would compare that rate of return if you're going to keep the property and as a result you can't pay off some debt.
Right.
You compare it to the interest you're paying on the debt.
Sure.
Right? Remember, in retirement, it's really for you all going to be about cash flow. Right. And by the way, that's how the wealthy usually look at it, is a cash flow situation. So if I'm getting enough cash flow from the rental property to pay the interest on the debt, right, and I've high confidence that this rent's going to continue, well, then you're paying the debt down that way and you're keeping your property, which is also appreciated.
Right.
When I wouldn't do it, Chase, let's say that you're getting on a $100,000 rental, you're getting $3,000 a year. So in effect, I could do the math and say I'm getting about 3%
Right.
In cash flow.
Right.
Well, if I'm paying 14% on a credit card interest,
Right. Right.
right? I've got a boat with a bigger hole taking in water, and I'm dumping out water at 3%, and I'm taking in water at 14.
Right.
So it's a bit of math you have to have your financial person do with you to do it. But start with the idea of just look at your investments, just like you would look at a stock or a bond or some other investment. Say, is this a profitable investment for me based on my assumption of what it's going to do over time? And then how am I going to pay off debt if I don't sell the investment?
Yeah, and I think you make a great point in that you have to do the math on not only the rental property, but also the debt. But one thing that, and I'm sure you would kind of co-sign with this, we see with a lot of our clients that have rental property, is you want to be very crystal clear as to what the actual rate of return is, right? Because sure, you may be collecting, $3,000 a month in rent, whatever it is, but you want to take into account the expenses that you're paying to keep up with that, right? The vacancy cost if the tenant were to leave, and then also the amount of work and time that you're having to put in to maintain that rental property. So if you have a rental property, and this is just based on our experience, revisit that, every year, every 2 years to make sure you're crystal clear as to what that rate of return is. And that will make the decision on the debt, a lot easier.
Yeah, I think it's disingenuous for folks who call rental income passive income.
Yeah.
For tax purposes, it's defined as passive income.
Sure.
But I tell all of our clients that have rentals, and I'm the one to ask, I've had as many as 11 rentals. You have to treat it as a small business. And if you don't, you do at your own peril, right? The tenants aren't going to take care of the property for you if you're not looking after your property.
Right.
So you better plan to put some time in to make sure you're keeping your asset protected, right? Keeping it up to date, clean, and fixing the pipes, whatever the damage is. So first question is, do I still want to be in the rental business? Right. And you're right. Most folks underestimate or overestimate the amount of their return because they're not calculating all the true costs. We can help with that, right? Find your advisor, even if they're investing you in stocks and bonds, they should be able to run math for you and see what your true rate of return is for your real estate. And then if you sell it, we got to figure in if there's any capital gains tax, what's that going to be hit? And is that worth taking that tax hit? Or is it better to leave it and use the cash flow to pay off the debt? So a lot to unwind there, right? And that's why you want to get with someone to help you.
Agreed. Okay, let's jump in. This is going to be the last one here for us, Dave.
Okay.
My son just graduated from college, and his grandfather, my dad, gave him $10,000 as a graduation gift and told him to use it to start investing. My son asked me what he should do with it, and I'm not entirely sure. What should I tell him? So I'll start off on this one. So really, I would say if you don't know, where he should put it, right? As far as, because there's a couple of different considerations. What account type to put it in? You have a Roth IRA, he could do a regular brokerage account. There's a litany of different accounts that he could possibly put the money in. So that's where you want to start, and then you can
buy real estate from the guy. Our last
That's
question.
right.
Get that guy to sell the real estate to your son for $10,000.
That's right. We'll go ahead and link them up, right? Just call us the in between, the middleman on that. But in any event, you just want to make sure that you're aware of all the different account types your son could have, and then you can really start to dig into which investments. I would say if your son is saying, "Hey, this money, I plan to invest it and I don't want to touch it for a fairly long time," right? Then he can be a little bit more aggressive. And by aggressive, I mean more geared towards the market in that situation. On the other hand, if he's like, "Hey, this is going to be used for a new car in a couple of years," we would give drastically different financial advice for that. So you want to have a candid conversation with your son about, "Hey, what do we want to use this money for?" And that will kind of dictate a lot of the investment.
And you know what, Chase? You said it very well. This is a great example of how everyone should frame the first part of your decision on how to invest.
Right.
It doesn't start with, should I get this mutual fund? Or should I, in the last question, right? Should I sell this property?
Right.
It should start with, what's the goal of this bucket of money? Forget investments, right? I got $10,000. What's the goal? Is it to save it, never touch it until I'm 70 and have retirement money?
Right.
And am I willing to not touch it for that point? If that was the case, Chase's point was that you should put that as much as you can over maybe 2 years into a Roth IRA.
Right.
The tax benefit of that will almost outweigh even making wrong investment decisions.
Right.
Right. But the downside is you can't touch it without a penalty.
Right.
So if you want to buy a car with it down the road, or at least have that option,
right.
Now we lose the tax benefit. So to keep it liquid and available, we've got to put it in a regular account that's going to have some tax consequences.
Right.
So it all starts with, if you're not clear what you want to do with the money, I would run away from any advisor who's giving you advice on how to invest if they're not first digging into how you want to use it, how liquid it wants to be, and how much risk exposure you're willing to take, which is a whole nother discussion that we have with our clients. Is that, people say, I understand the market's risky, but a lot of times we have a real fun way of showing them, hey, if the market in 2008 dropped 52 to 56%, depending on what part of the market you looked at, and people nod and go, yep, I heard that. But then if you actually do the math on their account, let's say their account was $1 million between their 3 accounts. I go, 56% is $560,000 of your life savings.
Right.
Where you see the light bulb come on is where the percentage was very theoretical. But when you're talking about dollars, for some people, that connected more.
Right.
So one of the things we'll do, and we would encourage you to do it, is kind of go through that exercise with your financial professional to say, look, I know in theory the market's up and down, and I know I'm supposed to not sell low, but do you have the guts or the constitution or the calm when you lose 56% to not panic and not have an ulcer and ride it out, even if it's going to take 5 to 7 years?
Right. So kind of put a bow on it. If just tell your son and have a kind of conversation with him about what you want to use the money for, and then that will kind of dictate, where the funds should go and what you should kind of invest it in.
Yep.
So that's going to do it for our mailbag series.
Yeah. I think we got some good questions.
Yeah, absolutely. As we kind of said before, go ahead and hit the like and subscribe button down below to be alerted for any of our future videos, and we'll talk to you soon.